Well, good morning. On behalf of my colleague in Milwaukee, Jim Brandenburg, I'm Tom Bayer. Welcome to our webinar today, the latest developments on federal tax legislation. Good morning, Jim.
Morning, Tom. Thank you
Before
for
we get
joining us
started,
here today.
Yeah, thanks, Jim. Before we get started, I want to cover a couple housekeeping items. Again, as always, we encourage you to submit questions via the question feature on the webinar control panel. We do anticipate many questions. We'll do our best to answer them, but if we can't during the presentation, we will send out responses to those questions after the webinar. So please submit your questions. Presentation slides today can be downloaded from the handout section of the webinar control panel, in addition to any other helpful materials. For those of you who want CPE credit today, there will be polling questions throughout, and we'd ask that you answer those so that you can get credit for the presentation. And I'd like to take a moment today, while this is an important tax topic that impacts all of us, we want to recognize, we want to send our deepest condolences to those who lost their loved ones during the tragedy that occurred at the Waukesha Christmas Parade in Wisconsin on Sunday evening. Our thoughts are with the families and friends and the entire community during this sad time. Take a moment of reflection. Thank you.
Thank you.
So with that, we'll get started. And today we're going to talk about, we've got Jim and myself, and today we're going to, oopsie. So it's not a good start to the program here. Here we go. We're going to talk about the bipartisan infrastructure bill, which, as most of you probably know, was passed, and the partisan reconciliation package with the title Build Back Better Act. So let's first talk briefly about the infrastructure bill. The infrastructure bill, as you might recall, was loosely connected to the reconciliation bill, especially in the House. The bill did receive bipartisan support, passed the Senate in August, and the House waited on the infrastructure bill. The progressives in the House did not want to agree to the infrastructure bill until the reconciliation bill was passed. Then they would support infrastructure. They were concerned that if they supported the infrastructure bill right away, it would lose focus on their primary concern, which is called the Build Back Better Act, also referred to as the Human or Social Infrastructure Act. So they were tied together. The infrastructure bill did pass the House finally on November 5th. It did have a few Republican votes, I think about 13 if I remember correctly. And then the president did sign that bill on November 15th. So in this bill, remember that the American Rescue Plan Act was the first major bill that President Biden put into place back in the spring. And this is referred to as sort of the second leg of the stool in terms of his major initiatives in the reconciliation bill. The Build Back Better Act is also referred to as the third leg of that stool. So, but in this bill, and we'll see this in the Build Back Better Act, a lot of social policy, a lot of initiatives, the money's flowing for broadband to get more access to rural areas of the country. Obviously, a lot of kids that are being homeschooled, if they're in a rural area and they don't have access to the internet, they're at a disadvantage. You can see clean energy, water infrastructure, low carbon and zero emission vehicles. So a lot of the policies that President Biden ran on are reflected in this infrastructure bill. So how are we paying for this? How are we paying for this bill? Well, a couple things here. Some of the unused funding from COVID-19 relief bills is part of the pay for delaying, Medicare prescription changes, revenue from selling some spectrum, broadband spectrum, auction sales, and other government assets, and then projected revenue gains from, economic growth created, jobs created. So those are really the non-tax related pay-fors. And then, tax related pay-fors, there's a increased focus on cryptocurrency. So there's an estimate here about 28 billion in tax revenue projected from enhanced cryptocurrency reporting. And so there's several provisions in here related to cryptocurrency. They define it as a specified security, which is some of the initial legislation around crypto. And we're going to see more of that if the Build Back Better Act passes. Amended definition of a broker. So to include someone who trades, provides any service effectuating transfers of digital assets, okay, on behalf of another person. So, and then it also puts cryptocurrency somewhat in the same level as cash in that second to last bullet point, in that if there's digital assets valued at greater than or equal to $10,000, they're really considered, there's a reporting requirement where any trade or business receiving greater than or equal to $10,000 in cryptocurrency must file this form 8300. And so there's a lot of controversy over this provision because there's really not a narrow definition of trade or business. So this could be pretty wide sweeping in terms of its application. And so all of this is effective in 2023. So we have about a year to sort of figure all this out. Tax-related pay-fors continued here. The employee retention credit was basically ended in the third quarter of this year. So even though the bill passed on November 5th and the president signed on November 15th, really halfway through the fourth quarter, at that point, before he signed that bill, we were still able to earn employee retention credit in the fourth quarter. So that has been retroactively rescinded. So there's going to have to be guidance come out. Several articles here recently on the IRS is aware of it. They're going to try to come out with some guidance for those that did actually take some credit in the fourth quarter already, but know that that's one of the pay-fors, is the money saved on employer retention credit that's not going to be paid out in the fourth quarter. The only retention credit available in the fourth quarter is this new startup business, recovery startup business credit. And so if you meet the qualifications as a business that started after February 15 of 2020, so you started during the pandemic, you can still qualify for employee retention credit in the fourth quarter, but that's really the only business that qualifies, okay? We did have some questions on this employee retention credit from some registrants, and a couple nonprofit organizations asked a question on, is there anything that is going to change on this? And as far as we can tell, the answer is no. So unfortunately, this is a stimulus that some of our nonprofit clients are counting on, and that has somewhat been pulled. So we'll wait for further IRS guidance, but as far as we can tell, that won't be rescinded. So that's an unfortunate timing, but that is the law as of today. So a couple other things, reinstatement of some Superfund excise taxes, modification of tax treatment of contributions to a corporation's capital under Section 118. This is interesting because the Tax Cuts and Jobs Act actually really took away some benefit from Section 118, which is capital contributions from governments effectively. That has been reinstated. It's very specific, and it relates to regulated utilities that provide water or sewage services. So they are now, again, eligible for these non-taxable contributions to capital. So again, you can see, and some of the social policies, some of the issues with lead pipes, issues in Flint, Michigan. I think the government is going to provide some capital to some of those utilities to try to address some of those environmental issues. So extension of interest rate smoothing options for defined benefit plans. This is really an extension, a 5-year extension of something that happened in the rescue plan, which is it allows some of these government pension plans to use interest rate smoothing, since we're in such a low interest rate environment, and it reduces the burden and the underfunding burden somewhat. So, and then lastly, modifications to private activity bond provisions. And this really relates to these what they call qualified carbon dioxide capture facilities. So there's going to be tax-exempt private activity bonds that are allowed to be issued, and they sort of expanded the definition to allow for these carbon sequestration facilities. So those are some of the things from the infrastructure bill. What wasn't in there, but we're seeing some of these provisions maybe come out in the Build Back Better Act. Additional revenue from enhanced IRS audits and compliance efforts was not in there, and no major business or individual income tax changes. So in terms of the bill that passed, those things are not in the infrastructure bill. So with that, I think we're going to go to our first poll question. Jim?
Yeah, thank you, Tom. Great overview with the infrastructure bill. Our first question, polling question here: which tax provision in the Build Back Better, the BBB Act, are you following the closest? And the selections here: individual tax rates, capital gain tax rates, corporate tax rates, foreign tax changes, and IRS audits and compliance initiatives. So please make your selection here. We'll give you a moment. Thank you. Okay, we'll give you a few more moments here, and we'll close this polling question out. Okay, the results here, interesting. Again, we've got the top two mostly for individuals. Individual tax rates, 43%, capital gain rates, 31%, and then lesser on the corporate rates, 16, foreign tax changes, 1, and then the IRS audits and compliance, 8%. So good cross selection of some of the items in this Build Back Better Act. Thank you.
Okay, Jim, you want to take us on with the next part of the presentation?
Sure, thanks, Tom. What we're looking at, as Tom mentioned, again, this Build Back Better is sort of the human or the individual infrastructure legislation it's been referred to. The politics of this one are different with it, in that this is a partisan bill, whereas as Tom mentioned, some of the parts of the infrastructure bill were bipartisan. This Build Back Better is a partisan bill. The Democratic leadership is controlling the whole process of the legislation with no Republican input. And it's being moved under what they call reconciliation rules, a special set of rules that Congress has that they've got to follow with it. And one of the things is in the Senate, they're able to get a simple majority of 50 votes, or 50 plus the vice president vote, not the normal 60 votes that they would have in the Senate. So it does change the dynamic quite a bit. So they're going to control the House. Now, even though that they control it, again, they have slim margins, as many of you may know. The House, there was just a 3-vote cushion that they had. In the Senate, there's really no cushion. With the 50-50 split, with the vice president casting any tie-breaking vote, really any Democratic senator holds a decisive vote with it. Again, they can have no defections with this bill. And 2 Democratic senators we have seen, Manchin of West Virginia and Sinema of Arizona, have been outspoken on certain parts of this BBB bill. And they've led to some changes in the bill. There were changes in the House that we'll talk about that really were because of some of the comments and efforts made by Manchin and Sinema. So let's move on to the next slide here with it. Again, this is just some of the overview of this individual infrastructure, some of the social spending area. Again, they're looking at families, some climate change, in addition, even some infrastructure besides, and jobs, even besides what was in the separate infrastructure bill, and also some healthcare items. Again, this is what they sought to include at the outset with it. Their initial focus or their approach was $3.5 trillion with their bill. To get it through the House, though, and again, with some of the changes, not only from House members, but with the prospects in the Senate, it's been trimmed back to about $1.8 trillion is the latest estimate with it. So that's kind of the overall landscape of what they're looking at with this Build Back Better legislation. And then as Tom mentioned with it, again, there were no individual or corporate tax changes in the infrastructure bill, but their game plan from the administration as well as Congress all along with this reconciliation package, this Build Back Better, is there were going to be higher corporate and individual tax changes. Again, some of the things that they tossed out initially were higher corporate rates, higher individual rates, higher capital gain changes, estate tax changes, IRS enforcement, a number of items. But one of the things they focused on was to limit any of these tax increases to those making $400,000 and above would have the higher tax rates, but those under $400,000 would not see any. That's what they have stated as their objective with this change. Okay, move on to the next slide here with it. I think this is an important slide with it as you try to look and digest what's in this Build Back Better. Many of you, and I think we talked about this previously in some other sessions we've had in articles. The first one with this, I put down as version 1.0 of this BBB was in September, mid-September, when the House Ways and Means Committee introduced its Build Back Better, the tax proposals with that. That was introduced again, I think on the 13th of September. They passed it on the 15th with it. Again, a number of tax items in there. We'll talk about those in a moment. But again, that even though it passed out of the House, it didn't go to the full House. I mean, it passed out of the House Ways and Means Committee, but it did not go to the full House with it. They were trying to move it forward, waiting to get support for it. And then on October 28th, there was this, they called it a framework that the administration as well as congressional leaders introduced, and they put it directly to the Rules Committee, not even the Ways and Means Committee, and they really redrafted the whole bill. And that's his version 2.0, and that was a major rewrite. A number of the items in version 1.0, especially some of the individual and corporate provisions, were taken out. They redid it. And then just a few days later, on November 3rd and 4th, they made some minor revisions to it. They added a few items with it, and most importantly, they put this SALT deduction, the state and local tax deduction, in there. So again, when you're looking back at what was in that House version, you just kind of need to know, was it early in the process back in September, or the one that was later on in November that actually ended up eventually here passing in the House. So we're gonna highlight that today. We're gonna spend a good portion of time on what the actual changes were. Again, most of those were in this version 2.0 and highlight some of the changes. Next slide
Hold on
here.
a second, Jim. I'm gonna try to get this full screen. I'm told.
Okay.
Let me see. Back. See if I can't. There we go. There we go. Okay, I think we're on the right slide here.
Back up two slides back, I think. One more. There we go.
Okay.
This is another important slide with it. Again, we've had a lot of questions or even some confusion maybe with it. I just wanted to highlight these. These were items, a number of the ones that were included in that House Ways and Means one, this version 1.0, but those were removed from the framework, that this version 2.0 that came out again in late October. The increase, these are items that were excluded that are not part of this bill. The higher individual rates, again, going up to 39.6, the higher capital gain tax from 20 to 25, higher corporate rates, tax treatment of carried interest, a change with the 199, the QBI deduction changes, the estate tax exemption that was going to be reduced, the grantor trust, all those items were pulled from this bill. This billionaire's tax was not technically part of that Ways and Means. It was tossed out there, and that proposal to do a mark-to-market with publicly traded stocks, that lasted about a day and a half and was removed also. So again, All these items were removed from the BBB bill, which again, a lot of individuals and businesses were following some of those proposed changes were taken out. Now, I caution you with it, again, as this bill moves forward to the Senate, some of those could be reinserted, modified in some manner. So again, nothing is final now, but those were pulled from the House version. So what we're going to look at now is what did they put in place when they did this framework, this version 2.0? What did they put in its place to get the revenue that they needed for this this Build Back Better legislation with it? So I'm going to go through the number of these, and Tom will as well, as far as some of the changes. Some of these may not impact some of you in your business with it, so we won't necessarily spend a lot of time with it. We want to make you aware of some of the changes. The first is this new corporate AMT. Corporate AMT was actually taken out in the Tax Cut and Jobs Act. This will be reinserted with a 15% minimum tax based on the financial statement income of a business. And again, these are larger companies with average income of over $1 billion. So we kind of indicate how this will be calculated with it. So what they're looking at is companies that report financial statement income but aren't paying as much tax. They could be subject to this corporate AMT. And again, it may not apply to some of the companies just with that size, $1 billion with it. But one where it could catch some business, this little toward the bottom, is if you have a U.S. corporation that has a foreign parent, those could be subject to this if their income is, if their U.S. income is over $100 million. So again, that may still be, not necessarily apply to too many, but again, if they change any of these thresholds, all of a sudden this corporate AMT could start applying. So something to keep an eye on with it. And this wouldn't start until 2023, so something to be aware of. Next one is the excise tax on stock buybacks or redemptions that they're putting in, or 1% excise tax on. Again, this is going to be publicly traded companies that they're going to look at with stock redemptions. Again, this starts in 2022 at a 1% excise tax. Next one is some new restrictions on interest expense, a new section on here. And again, what they're looking at is companies that have a international financing group. So they've got domestic and foreign operations with it. And, they're going to, if too much of that debt is, here in the U.S. with it, there's going to be some limitations with it. I don't want to go too much into the details with it, but I know there's a number of companies that have some foreign operations that are concerned with it. A lot of complexities with it. Again, needs to be over $12 million of net interest expense for it to apply. Again, does not apply with S corporations, so just be aware that anybody who's got a flow through S corporation does not apply. Something we'll need some more guidance on. Another change they made with interest I wanted just to mention is the Tax Cut and Jobs Act had this new limitation on business interest that was at 30%. Again, applied for C corporations, also for pass-through entities, partnerships, and S corporations. One of the changes they're making in this bill here is previously, there was this calculation at the entity level for that, for a partner or shareholder. What the change would be is these calculations for the interest are only going to be at the individual level, so at the partner or S corp shareholder level. So that would be a change with it. So something to be aware of. Any interest expense that's disallowed with it, however, will be indefinitely carried forward. There was a 5-year carryover in the House Ways and Means bill, that version 1. That's been changed, so it's an indefinite carry forward. So if you do have any disallowed interest you're going to get, be aware that you're going to have a longer carryover. And these changes for both this new change on the foreign interest, as well as for this 163J again from the Tax Cut and Jobs Act for the shareholders and partners, these start all in 2023. There were some other foreign provisions that they used to help fund this. The foreign provisions for the GILTI and the FDII modifications with it. They reduced the Section 250 deduction for FDII down to 24.8% and GILTI to 28.5%. So that yields the GILTI rate is at 15% and the FDII rate is 15.8%. Again, this applies in 2023. There are a number of other foreign provisions. We're not going to cover those today, but just be aware that if you do have some foreign operations with it, to be mindful of some of the proposed changes that they have within there. Next is one that we're seeing a lot of activity in the last several years is the Section 1202, this qualified small business stock, which can provide a significant exclusion. If you qualify for the company with it, you hold it the 5-year period, you could potentially get up to 100% exclusion from the gain with it. What this proposal would do, however, is there were several changes with this exclusion. At first was a 50% exclusion, then went to 75, then went to 100. What this change would be in this Build Back Better would be is that if your income and your AGI is over $400,000, you would not be eligible for the 100% exclusion or the 75% exclusion. It would only be the 50% exclusion for that. So something to be aware of, which really takes the some of the significant benefit and some of the planning that companies have done with the Section 1202 would not be available unless your income is lower. And the one thing with this is one of the few provisions that was effective when it was introduced in the House Ways and Means, again, for sales or exchanges after September 13th. Unless you had some type of binding contract on that date, again, these new rules are going to apply for you for Section 1202. Next slide, there's some wash sales. Tom had talked a fair amount on some of the changes with cryptocurrency. What they're going to do is make some changes with the wash sale rules and make those subject to digital assets, so that if you have a wash sale, you need to be out of the stock for a certain time before and after that sale. Those didn't previously apply to some of the digital assets and cryptocurrency. They're going to make some changes to that. Again, that starts in 2022. Next with it, this one is actually a favorable provision. So again, with all these are some tax increases, this one is actually a favorable one. In the Tax Cut and Jobs Act, one of the items that was in there, and again, it was just to kind of to fit it within the budget score that they needed. They changed the deduction for R&D for expenses under Section 174, that instead of being a current deduction for those, starting in 2022, what you're going to have to do is capitalize those R&D expenses and amortize them over a 60-month period. So this is separate from the R&D credit. This is just the expense treatment. They were going to make those capitalized over a 5-year period that you were going to have to do again, starting in 2022. What this Build Back Better, however, would do is delay that effective date until 2026 for that. So again, it's a favorable provision. So when you get to 2022, you'll still be able to deduct your R&D expenses with it. So again, this is one of the favorable changes in here for business in this area.
Okay, I think we've got our second poll question, Jim.
Okay, next polling question here. Okay, when do you think the Build Back Better Act will be passed by Congress and sent to the President? We've got some options here for you. By November 30th, by a week from today, between December 1st and December 15th, between December 16th and the end of the year, after January 1st, actually into 2022, or maybe you think the BBB will not be passed by Congress. Again, that's a possibility here too. So why don't you mark your selection here for this polling question? Thank you.
Hey, Jim, while we're waiting, maybe we could address this question that somebody posed. Your business must have average annual gross receipts of no more than $1 million over the 3-year period to get to qualify for the employer retention credit for the recovery startup business. And they're asking, if you began a new trade or business after February 15th, how do you meet the 3-year rule? I don't necessarily believe there's I think the average gross receipts rule applies to other things, but in this case, I don't believe that's the case. I believe that when you start after 2/15 of 20, you effectively annualize your revenue, and if it's under that $1 million threshold, I think you qualify. But Jim, do you want to comment on that?
That's correct. I believe that's correct. It was kind of an unusual provision that you said here you were starting out after February 15th to qualify for this credit. How would you have average receipts for 3 years, right? I mean, it seemed kind of it's kind of an anomaly with it, but I think they would look to annualize, what your receipts are to make sure they're sure that it's a small business with it. So I'll have to see if they've issued any IRS guidance on that in some of the questions that they've had. So
do we have some responses? Yeah.
Okay. Okay, nobody thinking we're going to get this by November 30th. We've got 17% by the 15th of December, 40% between the 16th and the end of the year, which again seems to be a lot of legislation, seems to all fall in there right before the Christmas holidays, that they seem to get something done, as they did last year, in fact. Actually into 2022, we got about a little more than a quarter of the folks, and then 15% don't think will be passed by Congress. So good. Okay. Interesting results with that.
It's a good spread. It's a good spread.
Yeah.
So thank you, Jim, for kicking us
Yeah.
off, and I'll continue with a few slides here on the Build Back
Changes. Thanks,
Better
Tom.
Act. The next couple here, this particular provision within the Act probably affects a lot of us, a lot of our clients, and that is an expansion of this 3.8% tax on more income, right? So if you remember, the Affordable Care Act is what brought us this provision under Section 1411 to charge 3.8% tax on what was called net investment income. So they've expanded the definition to include trade or business income. So a lot of flow-through entities, partnerships, LLCs, S corporations may have a K1, that owners may have a K1, and that income flows through. If it's an active trade or business for that particular taxpayer, then in the past it would have been exempt from the 3.8% tax. So this expanded definition, this proposal, would subject that income to the net investment income tax. So it applies to single filers over 400,000 in taxable income, and married filers over 500,000. So now remember that, and I don't believe, Jim, correct me if I'm wrong, I don't believe this proposal is inflation adjusting this number every year. So as we see inflation in our wages, this will capture more and more taxpayers. You agree with that, Jim?
I think so. Again, it's some of the things, are so many thresholds that they have here, and some are indexed and some aren't, and some have been in the past, but that'd be something to keep an eye on.
Yeah, so this could have a pretty major impact, and is, I think, projected to raise a lot of revenue within this bill. So any wages, right? The 3.8% tax does not hit the wages. Remember, wages get hit with that additional Medicare tax once you exceed either 200 or 250 in wages. Get hit with another 0.9% on those wages. So but wages are not included in that definition. So, and this applies beginning in 2022. So if this bill passes, that would be an immediate effect. Amends 461L, and this is related to excess business losses for non-corporate taxpayers, right? So remember that we had a $500,000 limit for married filing jointly, and $250,000 for separately, and those amounts were being indexed for inflation. So the numbers are a little higher in 2021. So that provision is being taken away, right? So no losses. There's no excess business loss provision. So the 500,000 goes to zero. And that provision is effective retroactive, right? So beginning of this year. So taxpayers would not be able to deduct any business losses. Those would be carried forward to future years. So, and that's a permanent change in this proposal. So again, another provision we think are going to affect a lot of our clients that might have these business losses, and it could be, frankly, a business loss created by depreciation as an example. So so look for that. The surcharge on high income taxpayers is a new, so there's a new surtax that's being proposed. The important thing to remember here is it's going to be imposed on modified adjusted gross income. So a lot of these provisions that we've talked about, you've got to pay attention to which number on your tax return they apply to. So a lot of them apply to taxable income, right? So taxable income is after we can take our, itemized deductions, charitable contributions, and things of that nature. So in this case, the surtax would apply to modified adjusted gross income, right? So it would impact taxpayers with modified adjusted gross income of $10 million. The first threshold of surtax is 5%. So married filing jointly of 10 million. Everything over that would get hit with a 5% surtax. And then for taxpayers with a adjusted gross income of 25 million, there'd be an additional surtax of 3%. So if you break this down on this slide, if you have income that is eligible for the qualified business income deduction, right, the 20% deduction, and that reduces your effective rate, right, because you get that deduction. So the combined rate would be 41.4% with this new with both of these new surtaxes. If you have income that's not eligible for the qualified business income deduction, it gets you up to 48.8%, right? And this is only federal tax rates, right? And it does include the 3.8%. So if you add the tax rates and you take the effect of the 20% deduction, it gets you up into a pretty high bracket. Now, remember a couple weeks ago, Elon Musk started to sell some of his stock, and it was mentioned in the article in the Wall Street Journal that some of this was related to some of the proposed tax increases, right? So it's a significant tax increase for those higher income taxpayers. How many taxpayers do we estimate this would impact? I saw an estimate that 30,000 taxpayers would be impacted by the first surtax, so AGI of over 10 million, and then of that 30,000, about 12,000 would be impacted by the second surtax. So I don't know how accurate that estimate was, but I thought that was an interesting number. The other thing, go ahead, Jim.
I was just going to say that the one thing too that some are watching this carefully is that, once you set that level at that threshold, perhaps maybe even in the Senate, they move those thresholds down from the 10 million maybe to 5 million or 2 million, and that 25 million down lower. Then then the impact, again, gets more of an impact to a lot more businesses with it. The other thing to note too is is the trust and estates. Those are pretty much lower levels down there. $200,000 can get this 5%, and even $500,000 at 3%. So, much lower than for an individual with these surtaxes.
Yeah, thanks for pointing that out, because obviously the first thing we think about when we see these is how do we plan around them, and of course trusts and estates are our trusts are great planning tools for those with high wealth. So, and I agree. I think remember we just talked about the 3.8% tax. They've now broadened the definition of income that would apply to if this proposal were put into law. So, here we are with these thresholds. We've got this new surtax, and I think the same principle could apply in the future. So beware of that for sure. So thank you for that. Okay. One of the things that we like to do is, we like to do these, Roth IRA contributions, traditional IRA contributions at year end, allows those dollars to grow tax-free. Another nice little planning tool. So the new measure in this bill would preclude additional contributions to Roths or traditional IRAs if the total value of the IRA and defined contribution accounts of a taxpayer would exceed $10 million. So, and the contribution limit only applies to IRAs of taxpayers with income of less than 400,000 single, or married filing separately, or 450 married filing jointly. Now, again, the other thing I want to point out and pay attention to these effective dates. This particular provision applies beginning in 2029, right? So 2029 is kind of a long way out. You know, there could be another, 20 or so tax law changes between now and 2029. So, but if you think about the value of an IRA today and you assume some, growth in that IRA, in addition to, contributions to it or contributions to your 401k plan, plus the growth just in the appreciation of the asset, a $5 million IRA today or $5 million combined account could easily be 10 million by 2029. So these provisions could sneak up on folks. Lastly, some other changes: a required minimum distribution for high income taxpayers with large retirement account balances. Here's that 10 million again. If it applies to a taxpayer, there's a minimum distribution of 50% of the excess over 10 million. So if you've got a $12 million combined balance in your retirement fund, we'll call it your retirement fund, which is a combined balances of 401k and maybe an IRA account, you've got to distribute half of that, or $1 million. Okay, this only applies again to those taxpayers that are over taxable income of over 450,000. So our minds start to go to, how do we manage someone's taxable income to keep it under that $450,000 through various means of charitable gifting and other planning ideas. So the distribution rules are even more what I would call egregious if your balances are over 20 million. So take a look at that. We won't get into the details. Again, applies beginning in 2029. Roth IRAs, we like to, a lot of folks, we like to suggest to them to do these backdoor Roth IRAs. So make a contribution to a non-deductible IRA and then convert it to a Roth. So that this provision would stop that from happening starting in 2022. So you couldn't do that anymore, and it doesn't matter what your income is. So that would not have any kind of income threshold attached to it. And then lastly, Roth IRA conversions for single taxpayers or married filing separately, taxable income 400, then married filing jointly 450. Couldn't do those conversions. Again, applies beginning in 2032, right? So think about the inflation in wages between now and 2032. That will apply to a lot of taxpayers. Won't be able to do those Roth conversions. With that, I'll turn it back over to Jim.
Good, thanks, Tom. Yeah, it's important, as Tom mentioned there, to watch these effective dates with it. We got a slide coming up in a moment here, but just some of these are, again, starting right away, potentially next year. Some it's 9 or 10 years from now. Next one, some other changes that we're kind of put in here at the end, just to be aware of union benefits being above the line deduction of $250 again would start 2022. Then uniforms, $250 above the line deduction for an employee uniform or work clothing, again, provided it's required as a condition of employment and must not be suitable for everyday wear. So if it is some type of uniform you have, again, that starts in 2022, so something to be aware of. Next slide here. This is an impact that if you've got any contingent fee cases with the attorneys, what they would allow is any plaintiff attorneys to deduct out-of-pocket litigation costs in the year these incurred, rather than waiting until the conclusion of litigation. Under current law, what they have to do is those expenses are in effect capitalized and wait until the outcome of that litigation, and then they can be expensed at that point. This would be an item for the plaintiff attorneys, would allow them to deduct those as those are incurred with it. That applies in tax years beginning after the law is enacted. So if it's enacted here, let's say here in December, sometime that would start 2022. Another one, if anybody has seen qualified sound recording productions, it's a new section 181. They could expense up to $150,000 in a year. That would start in 2022. Next one, again, this came about, I think, in the PATH Act back in, I think, 2015, which is for R&D credit. It's a special credit for startup businesses. So again, the R&D credit is generally a general business credit, for a company that is profitable, can offset their tax, but a startup company may have not paying any tax. So what they're allowed is to get an R&D credit that can offset some of their payroll costs. And what this change would do is increase that limitation from $250,000 to $500,000. Again, that would start in 2022. So that'd be a favorable provision for some of your startups. Next slide here. The last one we talked about, Tom mentioned it. I think one of the two main items I think that would affect a lot of the individuals from this Build Back Better. One is, again, he mentioned that NIT tax. The other, I think, is the state and local tax. And this has been one of the big item that's gone back and forth politically, both in the House and the Senate, is, they're trying to have, again, some of the wealthier and the higher income pay their fair share, but then they're providing the state and local tax deduction that, again, came about in the Tax Cut and Jobs Act. As you recall, the Tax Cut and Jobs Act put in a $10,000 limit on your state and local taxes, state income tax, property tax, and state income tax that you'd have. These versions, again, it came out, again, actually in early November. They increased that $10,000 to $72,500 for married filing jointly. And the next day, they actually increased it, made it up to $80,000. So $80,000 is the number that's in the bill now. And then it would apply for 2021. So again, that's a provision that would apply here in 2021, runs through 2030, and then it reverts back to $10,000 in 2031. So something to be aware of with it. Again, for any individual who had 10,000 before, now is up to 80,000 between property tax and state income tax, that full $70,000 increase for this year, that could be the $20,000 to $25,000 tax savings for them based on whatever, again, tax bracket they may be in. So something to keep an eye on with it. Again, we'll see what happens with the Senate with that. They could revise that in some manner.
The interesting thing on this provision, Jim, is the cap was set to expire at the end of 2025. So now
right.
There's a cap that's being beyond those years. They've sort of added this cap. So you would have had unlimited ability to deduct those state and local. If this bill passes, you won't.
Right. And again, and here's just a little chart that kind of goes through a little timeline of just some of the, again, selected items, just to keep an eye. 2021, again, we had the SALT deduction we just talked about, this section 1202 stock with that September 13th date. And then the excess business loss changes that Tom talked about. Again, these are items that apply in 2021. The stock buyback tax, the NIT tax that Tom talked about, the surtaxes, and some of these IRA changes, and the rules on the wash sales on digital assets. Again, those are key items for 2022. And then in 2023, the corporate AMT we talked on, the interest expense changes, the GILTI, and some of those foreign changes. So again, variety of effective dates. So whenever you're looking at some of these items, again, you'll find out what the provision is and then find out what the effective date is going to be with that. So, okay. Again, what we focused on here, again, the good part is some of the, they call the revenue raisers that we're going to pay for the Build Back Better. But again, this is a significant bill, the size and the scope and the amounts involved with it. There are also some other changes in it that aren't necessarily going to be additional taxes. There may actually be some tax savings or have some different focus with it. Some are what they call some of the safety net changes here, and just highlighted a couple of them. The expansion of the child credit. Again, the child tax credit is was at $2,000 per child. This last year with the rescue plan was increased to $3,000 per child and $3,600 for children under 6. That's going to be extended till 2022. They wanted to make it further beyond that, but again, with some of the cost with that, this is a very expensive item. They just were only able to include it for 2022. And this would also apply to the advance payment. Anybody who qualifies for this, you're able to get some of these child tax credit on a monthly payment that started in July this year for 2021. They would extend that into 2022. The other thing is starting after 2022 that any child credit you have will be refundable. In the past, only certain cases would be refunded that would apply going forward after 2022. Another change, a credit that would be out there is a new credit that's available for a tax credit for individuals that donate to certain public universities for research credit on certain infrastructure items. Again, it's a 40%, it's a general business credit. And again, you've got to meet certain requirements for the higher education. It has to designate it for certain research. It has to get approval from that, I'm sure from the Secretary of the IRS or Secretary of where, you know, who's ever controlling this, the research projects would grant that, and then they make those credits available for anybody who contributes to those research projects at those universities. The one thing for an individual is they don't get the deduction for it, they got to take that credit. So based on their tax rate, they can find out which is more beneficial for them. And then the last item here is a change for certain farmers. If they've received any payments under certain parts of the American Rescue Plan that came about earlier this year, those payments, if they receive those, will be treated similar to a PPP loan, that they'll be able to be not taxed on any of these payments they receive. Any of the expenses that they incur with those funds will be deductible, and they'd also get a basis adjustment if it was a flow-through entity, a partnership, or an S corporation. So again, they want to get similar treatment as a PPP loan if anybody had these particular loan payments for certain farmers. Okay, our next and last polling question here, again, kind of follows up on the salt deduction. Where do you think the salt deduction will end up at? Selection choices, leave it at 10,000. It'll be at 40,000. It will be at $80,000, is again, which was in the Build Back Better. It will be phased out for taxpayers with higher incomes. That's also been talked about, or something else. So please indicate your selection here for this question.
Jim, we can talk about this question in the chat box. Any thoughts on whether the NIT would apply to gain on sale of active pass-throughs or just operating income? And I would say the NIT is pretty much going to apply to all income that's not W-2 wages, that if you meet those thresholds. That's kind of how I
would agree with that. I think at least my read would be that would apply if you're above those thresholds, you know, the 400, 450, if you're above that. I think if you had an active sale of gain, I think that would apply for that.
Yeah, so
that'd be my guess, read with that.
Yeah.
Okay, let's see our poll results with that here. You got about 13%, leave it at 10,000. 16 percent at 40,000, about a quarter at 80,000. Again, was in the legislation in the House. Will be phased out with those with higher income. That's our top selection, 40%, or something else that they haven't come up with yet. So, okay, we'll have to see what happens with that. Again, there's some speculation that we'll have some changes in the Senate with that.
All right, thank you, Jim. Thanks for that summary. We'll jump into green energy changes. Lots of credits in this, more than we could put on slides. So we are only covering a handful of them, but if you read all of the different credits that are in this bill, that all revolves around, you know, the carbon footprint and clean energy, and really trying to incentivize Americans and businesses within the U.S. to really adopt more sustainable practices. So renewable fuels, you know, extension of incentives for biodiesel, renewable diesel and alternative fuels, second generation, also some sustainable aviation fuel credit, and then clean hydrogen. So all green energy, really trying to incentivize more green energy to be used. Green energy and energy efficiency incentives for individuals, right? So this is pretty significant, really. If you think about a $1,200 lifetime limit on you know, these implementing you know, doors and windows and different home energy type items. Now it's on an annual limit per credit per item of property. So I think exterior doors are $500 a year, interior doors are $250, windows, I don't have all those numbers, even applies to home energy audit of up to $150,000. So again, really incentivizing folks to adopt more sustainable practices, more energy efficient practices. Energy efficient property expenditures, solar, geothermal, wind energy, all of those things. And the credit is refundable starting in 2024. So this goes a 30% credit through 2031, but the refundable aspect of it doesn't start until 2024. So commercial buildings deduction, this is under 179D, and they've increased those deductions. It's kind of a sliding scale based on how energy efficient the improvement is within the building. So we can't really get into what that will be, but it increases the incentive for energy efficient improvements to commercial buildings. Also 45L deals with homes and actually deals with multifamily homes or units as well. That credit's pretty significantly increased as well. I think $2,500 or $5,000 depending on
Right.
the home, and then multifamily is an increase in that credit as well. So vehicles, right? Alternative vehicles. They've somewhat lifted the cap on how many vehicles can qualify for this. So credit on these vehicles, $4,000 plus an extra $3,500 if it's placed in service before 2027. There's some limits on the cost of those vehicles that would qualify. And then there's a phase out, right? AGI phase out here again, $500,000 of AGI. So they're trying to really incentivize those underneath that bracket. So you can also, interestingly, transfer the tax credit to a car dealership, right? And so, potentially treat the credit as a down payment on the vehicle, right? So interesting development here, assuming that dealer could use that credit on their tax return. And then there's several other vehicle credits and incentives, again, too many to cover, even for bikes, right? Even for bikes and for used vehicles, right? Used alternative vehicles also get a credit. So lots going on with clean energy. Also have mechanical insulation property, labor costs are subject to a tax credit. This advanced manufacturing investment credit actually deals with a semiconductor type manufacturing. So an incentive to try to bring semiconductor manufacturing into the US. And of course, if you read the Wall Street Journal today, you'll see that Samsung is in fact doing that. It probably is tied partially to this credit. They're building a facility down in Texas to build semiconductors to try to fulfill that shortage. Manufacturing production credit deals with manufacturing of green energy type equipment, solar, wind, and those kinds of things. So lots of green energy type incentives here, too many to cover, and I'll turn it over to Jim to take us home and to talk about next steps in Congress.
Good, thank you, Tom. Great summary with that. Again, just some important items to be aware of with this Build Back Better. Lastly, I just want to go through some of the, we get a lot of questions like, what's going to happen with this bill? What's going to happen in the House? And what's going to happen in the Senate? Well, here's the latest. Again, the House got this bill, again, once they made these revisions and changes. They returned to work really last week. And they had to wait for the score, which was the budget analysis from the Congressional Budget Office. That came out last Thursday, and it showed that the BBB was underfunded by about $370 billion. And they said it was going to be fully paid for with $370 billion off with it. They made some slight changes to the bill, nothing tax related with it. And that CBO score, while they waited for it to come out, didn't impact any House members in voting for it. So last Friday morning, they voted for this, and it passed by a vote of 220 to 213. So the Build Back Better now has been passed by the House, now moves to the Senate. So now we get to the Senate. The prospects in the Senate. Again, Senate's not going to take this up until after Thanksgiving here. There was a family leave provision that was put in the BBB that in the House that and some immigration measures that may be pulled out in the Senate with it. And there'll probably be some other changes with it. The other thing that the Senate has to deal with is There's a possible government shutdown. There's a raising of the debt ceiling in early December. I mean, this is a perfect storm for some late end of the year drama in Congress, that significant things. And again, the Republicans have mentioned, as far as this raising the debt ceiling, that the Democrats in the Senate and as the House are going to have to deal with that. And that's, they said, probably anywhere from the 4th to the 15th of December, that's going to be an issue with it. So again, they're planning to work on this Build Back Better in December, depending on how long that may take with it. It could slip into January, some are saying, just because of some of the other issues that they also have to deal with. So last thing, here's just some prospects, some other things in the Senate that could come up. Again, the Senate Finance Chair, Chairman Wyden, and others in the Senate really haven't had a direct input on this Build Back Better yet. They could add, delete certain items, and some of those changes could be significant. Some of the items we talked about that were pulled out in the House perhaps could find their way back in and restored in there. Then they have these peculiar rules called the bird bath, where the Senate parliamentarily gets involved, and if items aren't budget related, they can pull them out. They've already done that last week. There could be another chance to review that, so something to see. There could be some amendments proposed to the bill, perhaps, that, again, some senators, might be difficult for them to vote against certain items. And if any of those are adopted, then the House may have to deal with it. So these are all issues that need to be, again, if they do come to an agreement in the Senate, with Wyden and with Sinema and other senators, and they do want to move it ahead, it's probably, again, going to be a 50-50 vote with the vice president casting a tie-breaking vote. But again, if that bill is changed from what the House had, the bill would need to return back to the House with it. Then Speaker Pelosi would have to, try to persuade them to accept whatever the Senate did as the best that they could do and pass it. Again, if the House doesn't like some of those changes with it and change it again, then it's got to, go back and forth to the Senate, which I guess I don't see it going back and forth to the Senate. I think if it does get through the Senate, I think there would be pressure for the House just to accept what they did with it as the best that they could accomplish. So we will see what happens over the next couple of weeks here in December with it. So we appreciate that. We're just at the top of the hour here again with it. And we will try to get back to some of the questions that we did receive, Tom, that we haven't got through. I know we did a number of them. There's a few more that we can deal with then.
Yeah, so thanks everybody. And one question real quickly here. Somebody asked if the new president gets elected in 2024, can these be overridden and the rules change? And of course, that's going to be, the case. And I fear that we're in this continuous change of tax law, because remember that the child tax credit that's being proposed here only runs, that version of it only runs through 2022. So I could see us, Jim and I have talked about this, next summer being in a situation where they're trying to extend that credit again. And of course, if they need some pay-fors, that could involve some tax changes. So, anyway, so thanks everybody for joining us. We will have a survey at the end of this. As soon as we end the webinar, please fill that out. If you asked a question, as Jim said, we will try to get to it. And lastly, and most importantly, I wish everybody a happy and safe Thanksgiving. So happy Thanksgiving, everyone.
Thank you.